welcome everybody to our fourth week of Angel NV. Today we have our favorite person, Jeff Sailing, who is not only a founder of StartUpNV, he is a successfully exited founder, has had several different startups. Some he's learned from, some, were wonderful, is probably a good way to put it.
Some have exited, some have not.
There you go. If you guys know Jeff, you know that he's doing everything he can in Nevada to make sure that we are supporting found ups from legislature to just local programs all over Nevada. Jeff, I'll let you take it away from here.
Thanks, Roxana. Really appreciate that. And I am convinced that my lot in life at this point has me presenting on Halloween, because from a lot of my career, I was known sort of as the Grinch of Halloween, when I had many of our mostly services and sales engineers on the road on Halloween, and they all complained, like, how could you possibly have me on the road on Halloween? It's like, why would that be different? Our customers want us at their locations. We have sales calls to close. Why wouldn't we be on the road on Halloween? It's like, but it's a major holiday. It's like, it's a candy holiday. So I think because of that is why I am presenting on Halloween, because who better than the Grinch of Halloween to present on Halloween? So everybody, happy Halloween. And I will attempt to be spirited in my presentation of term sheets and terminology related with startup investing. So I have an agenda, which, I totally geek out on this topic. So if I get over exuberant, maybe Roxana, you can reel me in.
You got it.
But I'm going to try to stick to the basics. And if anybody wants to go down the rabbit hole with me and go really deep on something, happy to do it. But the way that I'm going to present this today is mostly taking entrepreneurs down the journey of how investors think about these term sheets, terminology, how investors think about valuation, so that when you're in a situation and you're talking to somebody about a price preferred round or a safe or convertible notes, and whether or not you should give an MFN clause or pro rata clause, and what your valuation should be, and why are they saying it's too high? Are they just a bunch of greedy bastards, or what? Which may be true, but there's some reasoning behind it. I really hope at the end of this you'll understand sort of the basic journey for getting a term sheet and what these terms mean, and why the investors are focused on getting a valuation of a certain size and a return of a certain size, and how that works. So I'm hoping by the end of this you'll at least have a little glimpse into not only these terms, but how the investors think about them. So I am going to share, find the right thing here. Here we go. So the basics, what we're going to cover tonight are term sheets, preferred stock and priced rounds, the terminology affiliated with them. Most of the terminology overlaps with the early bridge rounds, safes, and convertible notes. We'll talk a little bit about these different financing rounds and what they're called and why, how much of the overall money is involved in these rounds. And then I'm hoping we have time to talk about valuation and valuation caps as we get down to the end. I'm going to keep an eye on the clock and try to get us out of here so we can all go trick or treat. And for those of us here in the room, about 2 blocks that way, it's Halloween every night on Fremont Street. So I'm not sure it's going to be much of a change, but it is fun. So let's start with the most basic thing. What is a term sheet? First, it's not a contract. It is an agreement, and I would say it's a moral agreement between the person offering the terms to the founder and the founder agreeing to those terms. Make no mistake, it's not legally binding. If either party walks away, or if they want to change something on it, you can sue somebody over it, but you're not going to win. Plus, you don't want to have ill will in your community by having investors suing founders and founders suing investors. It's just not a good look. What it is, it's a summary of the basic terms of the agreement that we verbally agreed to. Sometimes an investor will just send you a term sheet. if you're in a really active market, that's oftentimes the case. If somebody sees, if a bunch of investors see the same pitch, they like the founder. In the really heated days of 2021 and early 2022, a founder would present and get 2, 3, 4, 5 term sheets. And that's not the case in the market right now, and it's really not the case in our Nevada marketplace. But if you're in a really hot market, in a really heated venture ecosystem, that might happen. And it's like a job offer, right? You're getting terms that this investor is willing to invest into your startup. It's not always exactly what the founder asks for in their ask slide on their presentation, but it's what the investor sees in this. And oftentimes those term sheets will come out before any due diligence is done. And they're always conditional upon, okay, well, you said that the TAM and the SAM were this big, and when we did our research, it's this big. So we're going to revise our offer. So it's really important that, when you're presenting, when you're doing your ask, that you're basing it, in all the research you've done, so that when somebody comes behind you and does due diligence, they're going to come up with the same answers. So everybody kind of starts from the same viewpoint. And that's really what a term sheet does, is it sets the conditions that we're going to make that an investor is going to make an investment under, and when the founder signs it, that they're going to accept the investment under those conditions. So one of the very first things that not only do you set the terms of the agreement, but how are we investing? What is the instrument that it's going to be invested under? So we're going to talk about a bunch of different kinds of investments. The 3 investments that you saw on the agenda: a preferred stock or a priced round, and then a SAFE and a convertible note. The most common type of investment by far, if you count up the number of investments that are done and the largest dollar volumes that are done on a priced preferred round. It's not something that's very common in the very earliest stages, but I'm going to start with this because a lot of the terminology that we use comes from the things that are in a priced preferred round. So the reason it's called a priced round is because we're establishing a price or a valuation for your company right from the jump. It's when you hear on Shark Tank someone say, I'm looking for $100,000 for 10% of my company, you've established a value of $1 million for that company doing that math. That's a pretty simple one. Usually when they say something like that, they're talking about, that's a post-money valuation, meaning that the $100,000 that would be invested in the $1 million company, the $100,000 would be included in that million. Therefore, it's post-money valuation as opposed to, no. I meant that the company would be worth $1.1 million after the valuation, which means that valuation is pre-money. So, but the priced round is what establishes the price or the evaluation for the company. Preferred stock is, you've probably heard of common stock. If you buy stock on the New York Stock Exchange or the NASDAQ or anything else, it's generally common stock that you're buying. And the reason it's called preferred stock is it's got certain rights and benefits that common stockholders do not have. And we're going to go through some of those rights in the next slide. The preferred stock is not senior to debt. So if the company has borrowed money and it goes out of business, the debt holders get paid first. The employees get paid first, and the debt holders get paid next. And then if there's any money left at all, in the case where a company is going out of business, the shareholders would get a piece of whatever's left, and the preferred comes before the common. So when somebody's investing, especially at an early stage round of investing, they want some extra special benefits that comes with preferred stock, which is the reason it's called preferred, is it has preference. If you're getting a convertible note or SAFE, which we're going to cover after preferred stock, the general assumption in 99.9% of the times is that when a convertible note or a SAFE converts, it converts almost always into preferred shares. And we're going to get to those before we do this. Most times, if you're going to do a priced round or a preferred round, these are rounds, $500,000. is probably the low end of what you're going to do for a preferred round. They can go to any level that you want. Like in my example, it could be $100,000 for 10%. That could easily be in preferred stock, but usually they're around $500,000 and up. You get into the A rounds and beyond, they're all preferred rounds, which is why if you look at how much money is invested in these different types of rounds, the vast majority of the money invested in startups is invested through preferred stock. So when you are getting an investment in preferred stock, or if you're an investor investing using preferred stock in a priced round, the terms are generally bucketed into two areas: economic terms and control terms. So I'm going to start on the controlled side of this because we're only going to cover one of the items in the controlled terms. You can see on the slide there's information rights, protective rights, drag-along rights, voting rights, investor rights, conversion rights. There's a whole bunch of rights we're not going to go into because we're not going to have time to go through all of that tonight. But the biggie, I'll say the two biggies are the first two you see there. Board seats. If somebody's investing with a preferred stock, they're generally going to ask for board seats. There's two kind of common ways that happens in the early rounds. Usually you're either going to have 3 board seats where the founder controls one, the investors control one, and then the parties agree on the third seat, or you have a 5-member board, which is kind of the same thing. So like the founders will get 2 board seats, the investors will get 2 board seats, and they'll mutually agree on the 5th one. Sometimes it gets broken up a little bit differently than that, but those are generally how the board seats are controlled. And as you probably already know, the board controls all the major decisions for the company. They may own a minority of the stock, but they will control major decisions like how much is the CEO going to get paid? If we're going to take on additional investments beyond this preferred round, are we going to do it? Is the company going to sign a lease for something? Is it going to borrow money? Is it going to commit itself to something? The board generally makes the decisions for all of those things. So even if an investor owns 10% of the company and they have 2 of the 5 board seats, they're going to control 40% of the votes on those very important things. So it's something from an investor's perspective where they may not own a majority of the company or even a plurality of the company, but they definitely will want to be in the middle of making the decisions, especially around debt and the payments to the executives in the company. Information rights is something very common. That just means that if I'm investing with preferred stock and I have information rights, that I get the quarterly reports every time, every quarter. So that's something that most preferred shareholders want to get. So those are the most common control terms that are in a preferred stock for a priced round. Some of the economic terms that are in a priced or preferred round. I'll stop quickly on cap table or capitalization table. It's really a listing of who owns what number of shares or what percentage of the company. It boils down to that. So if somebody asks for your cap table, it's, well, what's the ownership? Who owns what percentages of your company? There are a bunch of tools out there in the marketplace where, as your cap table becomes more complicated, that you're probably going to want to use a tool like Carta. There are others out there in the marketplace. I believe that Carta's program is free until you've actually got more than $1 million invested in your company. So it's really, if you develop discipline around getting your cap table organized from day one, Carta is a good tool to use. There are other Carta competitors out there that you can also consider. So a lot of people will keep it just in a spreadsheet in the early days, but you probably will want to convert to one of these tools at some point, because as you're considering different investments, there are ways to model your cap table depending on how the terms are in your for the different kinds of investments that you might have, that these tools are really helpful in doing. So it's a good tool to have at your right or left hand, depending on whether you're right-handed or left-handed, and something that'll be handy for the founders to have, and also so you can model things for your board and for any potential new investors that are coming in. Valuation. So I talked already about the difference between pre and post money valuation. Super simple. Pre-money valuation is the money before the round is completed, and the post-money valuation is what's completed after the round is completed. So in my example of $100,000 for 10%, you might, as a founder, say, as you know, that's $1 million pre-money, and the investor might come back and say, no, that's post, meaning that I'm buying 10% of the company, considering my investment, so that the whole value of the company is $1 million, including the $100,000 that I put in, meaning that money, that valuation is post-money. The founder might say, no, it's $1.1 million, meaning the $100,000 is in addition to the $1 million. So it's really important to get that clarification up front. You're going to find that many founders want to state their ask in terms of pre-money, and most investors want it to be in terms of post, because they want to know how much of the company they own, the investors, when this investment is complete. If it's pre-money, the founder can go out and continue to raise money, and it's like, I thought the company was valued at $1 million, and I would own 10% of it. Well, if that's pre-money, and the founder decides to go out and raise another $300,000 or $400,000, well, now the investor owns, let's say they raised another $400,000. The investor now owns, 1/15 of the company as opposed to 1/10 of the company. So it's an important thing to get established up front, is the valuation that we're talking about pre or post. The math is super easy, but most investors are going to want to understand what the post-money valuation is. So if you're in a market where the founders are ruling, like in 21-22, the founders are going to quote pre-money, and they're going to get away with it as long as they're saying, listen, I'm not going to raise more than $500,000. So the investor understands probably what they're going to own at the end of this, but they won't know exactly what they're going to own until that round is closed, those terms are closed, and we know exactly how much money is coming. So it's an important, pretty straightforward, but an important fact that you want to know. An option pool. This is something that there are hardly any preferred stock rounds that won't have an option pool that's sort of forced upon the founder before the round is closed, before they consider their ownership of the company. So almost all startups, you want to create an option pool for your employees and other helpers, board members and others in your company that you can issue to them. In almost all circumstances, the investor will insist that option pool be issued before they invest, because if it gets issued after they invest, they're taking dilution. The investors are taking dilution right away. So it's completely normal for the investors to want that option pool established before they invest. So don't think that the investors are being greedy bastards because they're asking you to do an option pool before they invest. Totally normal, and it's not something that a founder should object to. Occasionally, your friends and family and your early stage investors who might be investing won't think to ask that question. I would just generally advise that a founder that's got a C Corp and they're establishing and they know they're going to go out and raise, just carve up 10%, 12.5%, 15%, put it in the option pool, and then just go from there. Yes, you as the founder are taking dilution when that happens. You are giving up that 10% or 12.5 or 15% by doing that, but you're going to get asked anyway, and it's just easier if you just do it up front. And you'll also be thought of as, okay, this person knows what they're doing because they've already set up the option pool. It's an expectation. Preference. The whole reason that this round is called preferred stock is because the preferred stockholders have preference. And what that means is they're going to get paid first when there's an exit before any of the common shareholders are going to get paid. Not before the debt holders, but before the other common shareholders. The most common type of preference is non-participating preference. What that means is if you've got an offer to buy the company and it's a very rich offer. The non-participating preference means that the shareholders of preferred shares need to decide whether they're going to convert their preferred shares into common and then sell their shares at whatever that established price is for the exit, or if they're going to take their preference. So for instance, if they have a in the most cases, they have a 1x preference, meaning that if they've invested $100,000 at $1 million valuation, and you get an offer for a $500,000 to buy your company, meaning that's not a good outcome, right? You've established a value of $1 million, you're only going to get half when there's an exit. The founders, somebody with preference means that they get their $100,000 back before anybody else gets paid, before the founders get paid, before the common shareholders get paid, before anybody else gets paid. So if you get a low offer, they're going to take their preference, their 1x preference. Sometimes you'll see a 2x or a 3x preference, and it means exactly what you think it means. Meaning if I've got a 2x preference on a $100,000 investment for a $1 million company, and it gets sold for $500,000, I get my $200,000 back as an investor before anybody else gets paid. So if the price is low, people take their preference. If the price is high, if suddenly you're getting $10 million, well, you don't want your preference because you're only getting $100,000 in your preference. You want to turn that into common, and now you're going to take 10% of the whole part of the company. So there looks like there's a. Do you want to ask the question now, or do you want to hold on? So yeah, so the question was, is that what's the option? I mean, is that an option whether you choose? In the case of non-participating preference, it is an option. The shareholder has to choose: do I take my preference, or do I convert the common and sell? It's an either or, and it's a really simple math problem for the investor. Low price, taking my preference. High price, I'm converting to common and selling. And there's a break-even point. You figure out where the break-even point is, and you just make a decision which one you're doing. But the interesting thing is, the next thing we're going to talk about is participating preference, which means you can do, as an investor, you can do both. You can take your preference, meaning you'll get paid first, then convert to common. So it's a double dip, right? You don't see this feature used much. Where you'll see it used is when money gets really tight and founders get desperate. They will concede to a participating preference round. And if you get a participating preference round that has a multiple, meaning I'm going to get paid a 3x preference, meaning I'll get 3 times my money back, and then I'll convert to common and also be able to sell my shares. And because those preferred shareholders get paid first, they can suck up almost all the money in a buyout before anybody else gets paid, which is why it can be very punitive to agree to a participating preferred round. And I can tell you right now, this is one of those terms that if you give it away once, every single person who comes behind that in succeeding rounds is going to want exactly the same deal, or maybe even a more aggressive deal. So it's one of the sharkier terms in venture investing. But sometimes that's all that's left to you. I mean, there are plenty of times when founders have agreed to that because it was either that or the company dies. And it's not something that gets used very often. I'm going to say it's maybe 2 or 3% of all the preferred rounds have participating preference with a multiple. The norm by far is non-participating preference with a 1x multiple, meaning you get paid your money back before anybody else gets paid. That's pretty common, even when money's a little tight for founders raising on preferred rounds and otherwise. And you still really don't see many priced rounds that are, most of them are still the norm, if you want to call it that way, of non-participating preference with a 1x multiple. You're starting to see maybe some 2x multiples creep in, where I get paid 2x my multiple back because I need to be sure that I'm going to make that back. But for the most part, it's non-participating 1x preference. And these multiples can range. Most of the time they're 1 times, sometimes it's 2. I've seen them as high as 5. That's a little unusual. Again, it really depends on the market and how desperate the founder is and how much the founder knows. Sometimes there's sharky people out there that will just take advantage of a founder because they have never raised before and they don't know. I don't like it when I usually will call out that behavior when I see it in the marketplace because I don't think it's cool, but there are times when that's really the only road. There's just no other way for the founder to go when they're in a really desperate situation. I'm going to talk about 3 more terms, and then we'll move on to the safes and convertible notes. Anti-dilution. So the normal there's always an anti-dilution clause, and there are almost always an anti-dilution clause in your preferred round. And it protects, or doesn't protect, it explains to everybody that if you do have to take a down round, okay, we raised at $1 million valuation in this round, and market conditions got to the point where now I've got to go out and raise more money, but I have to raise it at $750,000 or $800,000 valuation, meaning that the company's not as valuable now as it was when I took my first investment. There are really two ways that dilution gets treated. The most common way is weighted average, meaning that the investors and the founders and all the people that are in the company now share in the pain of that lowered valuation in that down round. And there's a formula. There's a million different places you can look it up. I'm not going to try to explain it now, but the general idea is it's a weighted average, meaning that everybody takes a bit of dilution. And it's in relation to how much money you've invested so far. And that's pretty normal. What you want to be on the lookout for is something called full ratchet dilution. And when you pair this particular feature with participating preference with a multiple, this is how founders get wiped out. What full ratchet dilution means is that essentially the company is repriced at the new lowered valuation, and all of the investment the investor that has that right, all of their money is considered to have been invested at that valuation. So instead of having 10% of the company at $1 million valuation, if the company's valuation got cut in half, they now own 20%. They don't have to invest another dime. They just now own 20% because they have full ratchet, meaning that their money is counted as if it was invested at the down round valuation. And there's no going back on that. And that's another one of those features or terms in your preferred round. If you give it away to one, every single person who comes after has to get it, because if they don't, they're gonna get taken out they're gonna get diluted if the people that are in front of them have full ratchet and they don't. So you can imagine what might happen if you had a full ratchet dilution and you had a 2x participating preference. You as a founder could find yourself owning almost none of the company with both of those terms in the down round. You hear about these stories where the founders get wiped out, and these are the two terms to be careful of. And again, there are times when that's totally appropriate, depending on the situation that you're in and what the market conditions are for what you're doing. So it's just really important that founders understand, especially of all the stuff we're going to talk about, those are the two things that you really got to watch for and understand what your position is with regard to anti-dilution and the type of preference and multiples that you have involved in whatever this price round is. All right, two more that are pretty straightforward. MFN clause. A lot of times you can give away an MFN to avoid those last two things I talked about. And then you just got to be a good negotiator after that. Most favored nation. What you're agreeing to as a founder when you agree to an MFN clause, and again, it's something I know I ask for it in every single deal I make as an investor. That means if the founder agrees to better terms than they agreed to with me at a later round, I get those terms. So if you just suddenly decide that you're going to give away participating preference and a full ratchet dilution, even though I didn't agree to it, now I get that. So it protects me as an investor. And if I have board seats, I can help steer the conversation around, well, no, I don't think that's a good idea for the company, even though I would inherit those rights because I've got an MFN. But getting an MFN is really one way that you can protect yourself from having to do something crazy with an investor to say, listen, I don't want to agree to it with you. I promise I'm not going to agree to it with anybody else. And if I do, then you're going to get those terms too. And then you just have to be careful as a founder and as a board not to give away crazy terms later on, because all the people who came before, they're going to get those crazy terms if you agree to them. So MFN is, most favored nation, you're inheriting the best terms. And the last thing I'll cover before we move off of preferred and into the safes and convertible notes is pro rata rights. Again, totally reasonable thing for investors to ask for, and most do, meaning I have the right as an investor to invest in your company to maintain my percentage at whatever the new round is. So if I invested at your company at $1 million valuation, things are going really well. You go out and you raise the next round at a $3 million valuation. I have the right to maintain my 10% share at the new price. So I can buy more. I'm not getting the same deal I got before, but I'm going to be able to maintain my percentage. And most investors want to ride their winners, so that as the company is on the way up, they want to maintain their 5 or 10 or 20% or whatever they bought in your company. They don't mind paying up for it, because clearly the company's worth more money now because somebody's willing to pay that. They don't have to do it, but most investors will want that right. There can sometimes be a bit of conflict between your pre-seed and seed investors getting that right. You'll get into some of the really big venture firms saying, man, I don't really want these early stage guys on the cap table with that percentage of the company. I don't want to sell them that much of the company. I, as the big investor, want to own 20%. And if I have to give some to them to maintain their percentage, then I don't get all of the investment that I want. So there's sometimes where investors will be at odds with each other, but most of the early stage people, they want to have that discussion, right? They want to have that discussion with this new investor that's coming in. And a lot of times they can be talked out of it or bought out of it at that stage. And most of the time, the early stage investors want it, even though they oftentimes don't actually take advantage of it. Okay, so I'm going to pause now. Roxana's got a question, and then we'll move on to some of the others.
Question online from Bruce. When we receive a term sheet, will StartUpNV advise us with the review of the terms?
We will give you general advice. We aren't lawyers. We cannot give you legal advice. If you want sort of a market evaluation of whether or not you think this is, you have questions about it, of course we're going to answer your questions, but we can't give legal advice. We're not lawyers. But we will tell you what we think.
Thank you.
You're welcome. Okay. I'm going to move off preferred, and then if we have questions, we'll come back to them. All right. By far, the two most common ways that you're going to get early investment before you get to a price round is either a convertible note or a SAFE, a simple agreement for future equity. So I'm going to start with a convertible note because that's the old school way of doing it. And still, I think of the majority of all very early stage deals get done with a convertible note. So what a convertible note, it's simple. Instead of buying stock in your company at an agreed price, the investor is lending you money that will convert to preferred shares when you raise a preferred round. So rather than arguing with you right now, I think the company's worth $1 million. I think the company's worth 10 million. And having to wrestle with that, it's like, you know what? We're not going to decide right now. We're going to lend you the money. And there are a couple of terms that get involved in most convertible notes. First is there's always a discount, meaning, all right, since I'm investing early, whatever price is established 2 years from now when you raise it later, I'm going to get a discount to that no matter what, right? So 20% discount's pretty common because I'm taking more risk. I'm in before these guys that are coming later, so I want a discount. Or I want a valuation cap. Not the same thing as a valuation because you're not actually selling shares at that price, but it's totally normal to have that valuation cap. So the valuation cap and the discount, it's an either or choice. So if you invest in a company with a $5 million valuation cap and a 20% discount, when you raise a priced round, the investor is going to choose, do I want to take the discount or do I want to take the valuation cap? So if you raise it a really high round, like that 5 million, that you have that $5 million valuation cap or 20% discount, and you raise it a $10 million valuation, well, 20% off of 10 is 8, or I can take the 5. I'm taking the 5, right? So I want my money to be counted as if it was a $5 million valuation as opposed to taking that 20% discount. So the person who's got the convertible note gets to choose whether they take the discount or the valuation cap. Generally speaking, if you raise it a giant price, they're going to take the cap. If you raise it a price that's pretty close or lower than that valuation cap, they're going to take the discount. Because if you have a $5 million valuation cap and you raise at $4 million, well, I'm going to take, that means I get to buy in at $3.2 million because I get a 20% discount off of off of the $4 million valuation, as opposed to taking the valuation cap. And the investor gets to choose which one they want to do. Yes, sir. Okay, so he said, what if you only need to raise 5 instead of 10? And I think there was I'm getting that there was confusion about whether or not the valuation number. So in my example, if you raised at a $10 million valuation, you can only raise $2 million at a $10 million valuation, meaning that new investor is buying 20% of your company. And then the previous investor who had a convertible note would have their investment, whatever it was, whether it was $100,000 or $10, it would get converted in the scenario I said with the $5 million valuation. It would get converted as if they invested when the company was worth $5 million. So they would own a bigger percentage for their money, but they also invested much earlier than the other guys did. So they deserve some recognition for taking a bigger risk than the people who came later. And that's the difference. Does that make sense? Did I interpret the question the right way? Yeah, and so the comment was, that considering, you have to consider how much you're raising and what the valuation is. Both of those things are important. And you'll hear people say, yeah, I'm raising 10 on 40. I'm raising $10 million on a $40 million valuation, right? So that investors now, depending on whether it's pre or post, I'm going to assume it's post, that means they're buying 25% of the company, but if it's pre, they're buying 20% of the company. And depending on what your terms are in that convertible note, will tell you how, as an investor or as a founder, what percentage of the company or how many shares that investor is going to own based on their choice of, am I taking the discount or am I investing under the valuation cap? And then once that's converted, that's it. Then everybody's a preferred shareholder using whatever terms that we just went through in the preferred thing going on. Those people in the convertible note now have the same rights as the preferred shareholders in the round at which they converted into. The two other things that are important in a convertible note and what makes it a loan are there's always an interest rate, depending on the market. Back when there was you could borrow for 0 interest rates, a lot of these convertible notes were at 3, 4, 5%. Now you're seeing them more at 8, 10, 12% because the cost of borrowing has gone up, and that investor can put their money someplace else and get at least that interest. So they're going to make sure you pay for that. And that you don't actually pay the interest in cash. It just gets converted into more stock, right? So it's not like, hey, we converted and now I owe you 10% for this many years. No, it just adds up to money, and then that gets converted into more stock. And then the other thing is the timeline. Most convertible notes are 2 or 3 years. Back in the day when they were first invented, most of them were like 6 or 9 months, and they were really only made. The only time people did them was, all right, I know I'm going to get a price round 8 or 9 months from now. I've already got it all circled up. They got to finish their due diligence. I've got a term sheet or a commitment from this investing group who's going to invest the $2 million I want in 7 or 8 months. But I need money to get there. So people would write a convertible note. Was meant to be like a stopgap measure, 6 months, 9 months long. And you knew pretty much you were going to get funded in that period of time. Over time, that has been turned in sort of to an indefinite period of time. And you'll see convertible note after convertible note after convertible note. And it can get complicated on your cap table exactly how that plays out, depending on how many you have, what order they were in, when does the interest start and stop, what happens at the end of the term. If you go 3 years, you have a 3-year convertible note, you're in year 4. What are the conditions at the end of that note? Does it automatically convert? Does it just keep running? Does the lender have a right to call for their money to come back to them? All of those things are important parts of the convertible note that you negotiate with whoever it is that's giving you that convertible note. So it's going to have an interest rate, it's going to have a term, it's going to have a valuation cap, and it's going to have a discount. There are other, what happens at the end and some of the other things are important parts of it too. But those are the big 4 things that you have in a convertible note. And unless it's unusual, your convertible note will convert into the priced round at the same terms as whatever you've agreed to as a founder with those preferred shareholders. So all those crazy terms we just talked about, full ratchet, non-participating preferred versus participating preferred, multiples, all that stuff that you agree with that price round, the convertible note holders get the same exact terms, unless in the note it's called out to do something different. Every once in a while, a convertible note at the end of it will automatically convert into common. It's not unusual. It's a little bit unusual, but a lot of times it'll be like, okay, 2 years is up. The note was for 2 years. It's going to convert at the valuation cap to common. And you're, as the note holder, it's not something I would agree to as a investor. I would rather have the choice. Do I hold out for the preferred round and convert into that? Because the chances are, if they've not raised enough money, I can't just call the note. There's not going to be any money to pay me as an investor anyway. But I would rather have the choice. Do we continue this rather than having it automatically convert? All right, so that's convertible note. I'm going to talk quickly about a safe. A safe was an invention. I think it started it first came out in 2007, and then it was sort of refined in 2009. It was started by Y Combinator. And the problem with convertible notes is they show up as debt on the balance sheet for the startup, which makes it more difficult for them to raise money because they have all this debt. So YC said, well, what if we just don't call it a loan? What if we don't have an interest rate and we don't have a defined term? So it's not 2 years, it's just an agreement. It's going to go on until a price round that triggers it. And so it has all of the features of a convertible note, except it doesn't have interest and it doesn't have a term. So it's not bound by time and there is no interest. The original safes were very, very founder friendly, meaning that they only converted when the founder said they converted, right? Even if you got a priced round, they would say, nope, I'm going to keep it as a safe. I'm not going to convert you. And it was up to the founder and the board whether or not they converted those safes. Over time, it has migrated to be essentially a convertible note without the term and without the interest rate. But all of the other terms that we talked about, having an MFN and pro rata, information rights, some of the other things that we talked about in the preferred round, a lot of those terms have migrated into both safes and convertible notes. And the same commentary I made about them with regard to whether they belong in a preferred round and whether or not there's things that you should agree to, the same logic applies. If investors want to add some of those terms into a convertible note or a safe, you shouldn't sweat it. Watch out for the dilution. Watch out for you don't have preference in a safe or a convertible note, so that won't matter. But MFNs, pro rata, some of the other terms, they're popping up either in the notes themselves, either the safes or the convertible notes, or they're coming up in side letters, where you're agreeing to those terms outside of the actual legal document themselves. All right, so I went through a lot in about 45 minutes. So these are some of the things I talked about on the last slide. Valuation cap, the discounts and conversion pro rata rights, the interest rate and the terms. There are sometimes, we already talked about the most favored nation or the MFN clause. At the end, there can be time frames and redemption rights on safes and convertible notes. Like if this hasn't converted in 2 years, then we're going to turn this into a loan. Because the investors don't want their convertible notes and their safes to be out there forever. I've talked to a lot of angel investors who invested in a startup company 15 years ago, and they have a convertible note. The founder has now the company's pretty comfortable now. They're in no rush to sell it. They're making a good living. Their employees are being paid well. The company's profitable. And if you're an investor and you have a convertible note or a safe in this company, you have no way out. You have no shares that you can sell to somebody. You have no way out. The angel investors or the early stage investors who have companies like that in their portfolio, they call them zombies. It's dead money that you can't convert. So there oftentimes will be a redemption clause tied to time that says, if you haven't converted by this time, convertible notes have that built in. Safes don't always, so people will add those things and give you 2-3 years to do a priced round, and then at some point, that's it. Then the investor suddenly has a right. They may not take it, but they have a right to say, all right, this has been going on long enough. I want to be repaid in some way. There's a bunch of different ways that they could be repaid, that they can deem those notes or those agreements. But those are not uncommon and becoming more and more common.
Question from David online, and Maggie's already answered, but just for anybody in the room who's going to watch this recording later, is there a startup funding for dummies book? Maggie said Venture Deals by Brad Feld.
Well, so here, this was going to be my last slide, so I'll put it up now.
There you go.
The Venture Deals book, great book. It's really a 201. It's not a 101, right? If you want a 101, like for dummies, then the term sheets and preferred shares book that you see on the left-hand side of this slide is a much thinner and more abbreviated version. I think that one's like $6. The Venture Deals book is a little pricier, but it is the standard in the venture industry. And I think the picture of the book I have is 3rd edition. I think they might be up to 6th now because I've had it for a while. But those are some of the For Dummies book on term sheets, valuation, and venture deals. That's more of a 201. Gets a little. If you think this was geeky, wait till you read that book. Okay. Any other questions out there?
Not online.
All right. So people get confused about these. What are these rounds called? How big are they? How much money is actually involved in them? So just really quickly, self-funded, founder-funded. It's hard to really track how much of that goes on out there in the marketplace, but it's millions and millions and millions of dollars of founders funding themselves to kind of get started, right? So it's not really well tracked, but it's lots and lots and lots of money of founders funding their own companies to get them going. The next stop on the funding train is usually friends and family. Sometimes it's called friends, family, and fools. So they add the 3rd F in there. It's a significant amount of money. It's not. It's usually small amounts. $5,000, $10,000, $20,000 is usually what you can get out of mom, dad, uncle, Raymond, or whoever to fund your company. People who love you, people who trust you. They're probably not really slick investors, so they're not going to know any of the stuff that we just talked about tonight. But it's usually the easiest money to get if you're in a community that has that kind of funding, and it's all very informal. There's not an organized way of doing it. Incubators and accelerators, like the one that we run at StartUpNV, a pretty good chunk of the market. Usually, you're going to get a check somewhere between $50K and $250K, somewhere in there. And a big part of the market, about $4 billion of all the money that gets invested every year, is usually coming from an accelerator or an incubator. Then you got the angel groups. And some of this money kind of fluctuates between the angel groups and the incubators and accelerators. That kind of gets a little bit munged together. Some of the bigger angel groups will write a check with $2-3 million, which can be significant. A lot of times those are coming from not the group itself, but a bunch of individual investors within the group. It's like, all right, one guy's going to put in 100,000. Another guy's going to put in 750,000. Another person's going to put in 500,000. Now you've got all these people on your cap table, and they're all signing hopefully the same deal. But it's the angel groups. Oftentimes, the old school angel groups are investing as individuals within that group. And it's a big chunk of money in the early stage capital gain. It's about $25 billion a year. We're not going to talk about Reg CF or the crowdfunding stuff, but it's back in 2012 when that was put into place, the idea was, well, why can't just the regular public buy shares, common shares in these startup companies? And there's a lot of regulation involved in this, but the companies have to go through not audited, but reviewed financials. And, if you think you're going to go out on a Reg CF crowdfunding platform and start selling shares, just brace yourself that it's probably going to cost you between 25 and 50 grand on the platform and with accountants and lawyers to get your company in shape so you can go on a crowdfunding platform to get an investment. Typically works pretty well for consumer-facing things. Things that are really tangible and for people who like the product to get behind and buy shares in your company. Not a huge part of the market. It's growing a little bit, but it's kind of stalled out at about $1 billion a year. Where the really big money is in the Series A round, which is usually your first priced round. A lot of times the money that's invested by incubators, accelerators, angel groups is invested with convertible notes and safes until you get to the bigger angel groups. But once you get to an A round financing by one of the big venture funds, it's almost always going to be a preferred round. You can see that's a pretty chunky amount of money. And these numbers here are sort of averages for the pre-2020, the slide that we're seeing right now. A lot of these numbers in the venture capital A round and the future rounds, they've been reduced by as much as 50–60% in the last year and a half, because they're all holding on to their money at this point, because interest rates are high. You can get a good return by just buying a government bond. There was a lot of money raised at pretty crazy valuations in 2021 and 2022, and so the companies are kind of burning through that money now, and most of the venture firms are like, maybe we went a little too far with some of these valuations, so we're just going to hold tight for a bit and see who survives, and then we'll come in later with more money. So these numbers are a little bit skewed high on the Series A and the other venture capital rounds. They're a little bit lower than that in this year. So if you go out looking on Crunchbase or any of the other databases that are out there, you're going to see that some of these numbers, they're lower in the last year than they've been in previous years. And we've already talked about how the pre-money and post-money valuation works. And I'm going to spend about 5 minutes talking about why valuation is important and kind of what it means. Now, we created a valuation calculator that's free to use. All you got to do is sign up with your name and your email address, and then once you do that once, you're going to be able to use that valuation calculator over and over again. And it's going to ask you a bunch of questions. How much are you raising? What valuation do you want? And it's going to show you, sort of from a investor's perspective, whether or not an investor is likely to like that or not. So it kind of gives you green, yellow, red in terms of, is this a deal that most venture capital people will be willing to do? So a couple of things to understand, and I'm gonna try to put you in the mindset of an investor, a venture fund. A venture fund has to return at least 3 times the fund size, 3 times the amount of money back to its investors as was invested. So at least $3 for every dollar. So if you guys were all my LPs, you gave me $100,000 to put into my venture fund, your expectation would be that somewhere between 7 and 10 years, I'm going to give you at least $300,000 back. At least. You know why? Because you can invest that same $100,000 in the stock market and guarantee get about, well, over the last 125 years, the stock market index fund has averaged about 7.25%, which means you're going to double your money in like 7, 8, 9 years. So if I can't get you at least 3x for all the risk that we're taking, well, why would you do it? Which is why that 3x floor is what most venture funds are looking for, especially in the early stage. In the early stage, you actually want it to be closer to 5 than 3 because the risk is immense. And I'm going to explain that in a second. Most venture investors think in terms of cohorts, right? So 20 company cohort is what they're investing in. And the reason some of these numbers come into play are because of those 20 companies, 15, 16 of them, they're going to zero. Nobody thinks that's what's going in. Every single one of these companies, when you invest, you think, this is my 30x winner. Every single one of them. But just look at history. The history tells us that no matter how careful we are, no matter how good of an investor we are, no matter how great of a deal that we strike, 75% of these companies I invest in, they're going to zero. 3 or 4 companies out of that cohort of 20, they're going to return some capital. Maybe 1x, maybe half the amount of money that you invested will come back to you. Maybe 2 times the amount of money it'll come back to you. But not enough that gets you your 3x return on the entire fund. The only way you get the 3x return on the entire fund is at least one of them or 2 of them hit 30, 40, 50x. And that returns the fund and it makes up for all of the ones that went to zero. And still, even with that, you're still probably only going to make 3x or 4x on the entire fund. So, and the only way you get there is if at least one of those companies is going to hit 30, 40, 50x, meaning for every dollar you invest, you get 30 or 40 or $50 back. And I know this drives founders crazy. It's like, you guys are just a bunch of greedy bastards. Why can't you be satisfied? You say you want 3 or 5x. I can get you 3 or 5x. Okay, well, that's great. But if I invested every company that way, I wouldn't even return my fund, because if that's the only one that returns 3 to 5x and 3/4 of them go to zero, I don't even make back the money I invested. So as an investor, they are looking at every one of your companies and saying, can this company, with the founders that are in charge of it, return me 30 or 40 or 50x? And if the answer to that is no, they're not going to invest, because you need to believe that every single one of those companies can do it, or you won't return the fund. You won't return the money to your investors. And I know if you guys were my LPs, you would be saying, you better make some better deals with these companies, Jeff, because we know 3/4, no matter how good you are, 3/4 of them are going to zero. And just to put a fine point on that, I'm going to stop sharing this slide. I'm going to show you one little spreadsheet, and then we're going to be at the end. This number. So this is our portfolio. This is a 20 company portfolio. We're going to make the math easy. So we have a $5 million fund. We invest $250,000 in every single company. So you can see the ones in red at the bottom. They all went to zero. So we're 10 years into the future. 3/4 of these companies have gone out of business. We get nothing back for them. 4 of the companies, they returned a little money. One of them returned half the investment, $125,000. Another one returned the whole investment. Another one returned 2x. Another one returned 2.5x. And our one company returned 40x. So we returned $10 million on a $250,000 investment for that company in position number 1 there. Now, if you only invested in that one company, brilliant, you got 40x on your money. But you have to be really lucky, because history tells us that 3/4 of the companies you're investing in, no matter how good you are, they're going dark. Sometimes that's because the founders don't get along with each other. Sometimes market conditions change. There's a zillion reasons why companies don't make it. Nobody goes into it thinking that that's the case. But yet, this is what our history tells us. So out of that $5 million fund, if you had invested that over 10 years in the stock market, making 7.28%, you would have returned just a little over 10 million, about $10,100,000. So that's your floor. That's the worst that you think you're going to do. Under this scenario, where I got 40x from the one company, I got $11.5 million back. So I got a little more money, about 13% more money than I would have gotten by investing in the stock market. But I just took up a huge amount of risk putting my money at play with these companies. So this is sort of the bare minimum from an investor's perspective, and that's part of the reason why when you guys are looking at it, I'm thinking, you guys are a bunch of greedy bastards for wanting 30, 40, 50x from my investment. This is why. This is why they want 30, 40, 50x. Because what you're seeing right now on this spreadsheet is the reality of how startup investing works, especially in these early stages. So when you're calculating your valuation or your valuation cap, and the investors are looking at this saying, your valuation's at $10 million. I'm going to get diluted as more rounds come in. I've got to figure out how to get 30 or 40 or $50 back for every dollar I invest in you. And if I can't make that math work because you've started the valuation too high, I just won't invest. So getting your valuation right so that you can explain to an investor, I can show you a path, Mr. or Ms. Investor, that even with the dilution that you're going to take as more companies invest, as more people invest in my company as it grows, that I can get you to a place where you can get 30 extra money. If you can show that path to an investor, it takes one of the major objections right off the table. They still have to believe that you're in a big market, that you're solving a painful problem, that you, in fact, are the founder or set of founders that can actually get the job done. But assume you've got all that covered. Now your next big challenge is going to be, am I selling this at the right valuation? And a lot of founders will get all bound up in this and say, but I don't want to be diluted because that money's coming out of my end. That I am going to be diluted if I have a lower valuation. And my argument to that is always, it's better to have 10% of something than 90% of nothing. So if you actually believe in this journey and what the market that you're going after and the solution that you've got, then come out, especially in the very early days, at a reasonable valuation, get enough gas in your tank that you can get to the next round, and go from there. Because if you don't show the investors a way to make, 30, 40, 50x, even with the dilution they're going to take, unless you're dealing with somebody who just doesn't know what they're doing, friends and family are never going to put you through this. They don't know this. But anytime you get to a professional investor, somebody like what our fund does, and we're small potatoes compared to some of the people that are out there. You're dealing with an angel group that does a lot of investing. They all know this. They all think in cohorts exactly like this. And every one of them, they have to figure out, how am I going to get to 30x, 20x, 30x, 40x, 50x? Not because they want that. They don't expect that from every single company, but they know the math. They know that 3/4 are going to fail. They don't know which ones, because they believe all of them are going to succeed. And the venture guys that want you as LPs in their fund, like if I was selling you as, hey, I want you to invest in my fund, I'm going to tell you, I do a better job at picking than most people. Most people only get one winner out of 20. I'm going to get you 2. And if I change one of these, if I change that 1 to 2, if I get 30x out of this guy, well, suddenly I got $18 million instead of 11. So moving the needle on one as a venture investor makes huge returns for your LPs. But nobody's betting on that, because you're betting against history. No matter how good the venture investor is, chances are it's going to look more like this than the one with more than one winner in it. So hopefully you guys have found this to be helpful. And I know it was like I'm standing up here with the fire hose, just unloading on you. So hopefully it didn't get too geeky and too deep, and this stuff starts to make sense. So I'm gonna stop sharing and see if there's any questions. So Roshana's got a question.
First question, what sort of valuation range for 250K in?
What's the valuation range?
For 250K in. Yeah, what sort of valuation range for 250K in?
Well, that totally depends on what business you're in. A company, somebody asked me to put the books up again, so let me share the screen again. So there's the books for anybody who wants them. And if you guys want a really interesting, I'm going to get to that question in a second. If you want a really interesting view of how venture capital got started, there's this Freakonomics podcast about the history of venture capital. It started in the whaling industry. And as the crews went out to do whaling, they were getting doctors and lawyers, mostly in the northeastern part of the United States, to invest in these vessels. And that's the very first seeds of venture capital in the U.S. In terms of how much valuation should you ask for, or what should the valuation be for a $250,000 investment? I hate to have to tell you, it depends answer. If you have a very scalable business in a market that's super capital efficient, you can probably ask for a little bit better valuation than if you're in a less competitive field, which, like consumer packaged goods. Those are like grand slam. You have to hit a grand slam home run if you've got a consumer-based company, because the amount of investment that it takes to market and create a brand and design a product and actually sell it and distribute it online is a significantly higher risk than somebody that's writing a B2B SaaS, where it's a couple of software engineers that are creating something. There's no hard goods or a lot of marketing involved. It's a much more capital efficient thing that you can invest in. So depending on kind of what end of the scale are you on? Are you creating a new drug? Super capital intensive. $250,000 is like spitting in the ocean, right? You need millions of dollars to these tens, hundreds of millions of dollars to get a drug to market. So your mileage may vary depending on what business you're in, what the multiples are. You can look up what the multiples are, for exits in whatever industry you're in. The reason I've had a good career in enterprise software as a service businesses, we sold really geeky back office solutions to giant corporations. And once our software was installed in there, unless we were doing a really bad job, it was not coming out. And getting it in, getting the software design, that takes some lifting. But once you're in, you're not getting out. You're not going to have a lot of churn. And therefore, those companies tend to have a higher valuation multiples. You might get 6, 7, 8 times your sales when you're getting acquired from a valuation perspective. If you're in a business that has a lot of services, meaning the only way you scale is by hiring more people, your valuation oftentimes is like 1x your revenue. That's why professional services companies, whether it's a marketing professional services company, an engineering professional services company, a legal professional services company, if your revenue is $10 million a year and you're trying to sell the company, you're probably going to get about $10 million. If you have that same software company that's selling software to enterprises, you get $80 million for the same $10 million in revenue. So you have to figure that out when you're saying, what percentage of my company am I going to sell for $250,000? What industry are you in? Are you more in a services industry? Or are you more in a software as a service kind of multiple? And then you can start to figure out what it might be worth to invest.
Kishore, who's online, is asking, is 250K an average? What is the max? Kishore, I think Jeff just said it depends on your business model. It depends on what your product or service is.
The $250,000 in my spreadsheet was just an example. I can tell you, like the FundNV, if you get into our accelerator, StartUpNV, FundNV, the venture capital company that invests in those startups, it invests $50,000. Now, we also go out to our limited partners and to our network and ask for more. We say, we're investing 50. Are you with us? And on average, we've managed to raise about $125,000 from our group, and then that gets matched by the state. So our investments that seem like they're small at $50,000 oftentimes turn into $250,000. But there's a lot of people in that boat. They all come in through us, but there's a lot of people in that boat. So very early days, very early stage startups, most of those investments are 25K would be a little on the light side. 250K is probably a little on the heavier side for your first investment. Unless you're an exited founder, you've got a lot of proof, you have a resume that people will believe in, then maybe you can raise more, maybe you can raise at a better valuation for you as a founder because you've got a bit of a track record. But there's a lot of venture firms that won't invest in second-time founders. They'll invest in a first-time founder, but the sophomore curse is a real thing. Once you've had one success, it's like you get a little arrogant. You think you've got the world figured out, and whammo! You know what? Your chances of success in your second one is maybe it's a little bit better than 20%, but it's still pretty low. And if you don't have the right attitude, there's some firms that'll say, I'll invest in the right first-time founder. I'll invest in third or fourth-time founder. But that sophomore curse sometimes is a tough thing to break.
You may have already said it in the beginning, but so angel investors, are they looking for 10%? As far as the company as they when they invest, or what's their percentages?
Every investment firm has a different thesis. As you get further up the stack, the higher values of money. Like it's unusual that either a big seed or a small A is going to want to own less than 20% of your company. So they'll try to figure out a valuation where they can buy 20% of your company because it gives them the best chance at a good multiple on exit. And if they own less than 20%, they just figure, the bet's not big enough, that it's going to be meaningful to my fund. As you get lower down the stack, the expectation of ownership changes. It sometimes is gone altogether. Like when we invest from FundNV, we're trying to get that formula right? We're not going for a certain percentage of ownership. We're just trying to get that 30x, 40x formula right so we can return money to our investors. We don't care if we own 1% or 10%. It's more about the ratios. So as you get into more mature venture investors, they are going to have a thesis. Usually it's somewhere between 10 and 20% is what a more mature venture firm, they say, I'm not even going to bother if I can't own at least 10%. And which is good. I mean, that means the money is bigger, right? Because the expectation of ownership is bigger. You know, some individual angels will have that same perspective where they say, I'm not going to do it if I can't own at least 5%. You know, the numbers are usually smaller because they're individual people as opposed to a big group or a big fund. But you really want to sort of learn as you're trying to do business with these guys. They do have a minimum ownership percentage. And if you can do almost all of the firms, you can look at it. They all have websites. Most of them tell you exactly what their thesis is. They'll tell you exactly what kind of companies they invest in, tell you exactly what stage they're going to invest in. They'll tell you exactly what kind of ownership they look for. Almost all of them will tell you that. So look them up on Crunchbase, look them up at their own websites. It's usually not a secret. And they will come right out front and tell you. The individual angel investors, well, we're all unique snowflakes as humans. So we each have our own, they'll each have their own way of doing it. But if you ask them, they'll tell you.
So I know you talked about like the friends and family and potential fools in the in the first round. I guess when you're then trying to go for either angels or venture capitalists, would it look bad if you, or would it kind of be a deterrent if you kind of started giving away ownership in that friends and family round to now have like, to basically have like, friends and family on a cap table? Or is it like, I guess like kind of standard or expected to maybe eventually, that's to have like friends and family like early on, having ownership of the company?
It's not unusual to have friends and family on the cap table, especially at an early stage company. What you'll find a lot of experienced founders do that have raised money before is they'll open their own convertible note or their own safe. And instead of having individual people come onto the cap table, they'll just have even some of their own money they'll put in through a safe or a convertible note to keep the cap table clean, right? So, if you've got 5 people in your family that each want to put in, somewhere between $5,000 and $10,000, maybe it adds up to $50,000 altogether. Write your own convertible note, write your own safe, have them invest in that instrument and have that instrument invest in your company. That way it keeps your cap table clean and you don't have, Uncle Roland, in the first place on the cap table. And you get to your A round and it's like Ben Horowitz is looking at this going, who's Uncle Roland? Is he on the board? It's like, so, it's not horrible, but if you can think about it in advance and create, use the Series C term sheets and some of the other things that are available online, and you can essentially, get your own documents and have people invest in them that way. A little bit more administration and a little bit more cost involved in doing that, but if you're in it for the long term, the few $100s you're going to spend on that up front is probably worth the potential pain of having Uncle Roland and Aunt Martha listed individually on your spreadsheet or on your cap table. Sorry.
So how do you guys go about raising your funds for the fund, and how often do you actually do it?
Same way as you do it as a founder. We go out and we beg for money. We state what our thesis is. It's a lot of networking. And part of the reason is that we run the Angel NV annual fund every year is to create, 50 to 60 new investors in the ecosystem every year that will not only invest in that particular thing that the fund does, that group of investors does with that one annual fund, but now we've got another 40 or 50 investors in the community who are familiar with this game. Now, they may not want to write a 50 or 100 or $500,000 check into our fund, but it's the start, right? If you're raising a big fund, 150, 250 million dollars, $500 million, then you're going to institutional investors. You're going to pension funds and family offices and things like that. For $50 million and less, you're probably raising from individual high net worth individuals. And the way we raise it is networking, finding people that have interest in the particular thesis that we invest in. We find founders that most other people aren't going to find. Nobody comes to Nevada looking for these awesome companies. We're going to find them all here. And if you think that there's something here, like every new startup ecosystem usually has, several really good deals that nobody expected unless you're in the Bay Area. And there's a zillion people competing for all those founders, right? So we're going to find the founders where no one else is looking. We're going to find the awesome people where nobody else is looking. That's why investors will invest with us. Plus, they probably usually have some affinity for our geography or for whatever our thesis is. There's usually a little bit of a less logical reason that they just want to see this succeed, or they want to say, I was there then when it was nothing, and 10 years later, it's like, not only did I make some money, but I also looked brilliant. I was ahead of the curve. There's some ego involved in all this. It's why you're founding a company. It's why we're investing in companies. There's a little bit of ego in there too. So, but the main thing is you want to be able to look them in the eye, promise you're going to do a good deal, and then really do the work of finding the founders and making great deals. And if they believe you, they'll invest.
So,
yeah. So there's no shortcuts. It's a lot of begging, essentially.
So what happens when you don't have something if you don't go through your funds in the year? I mean, it's still a goal to do that.
Oh yeah, part of our investment thesis is, generally speaking, you take 12 to 18 months to raise your fund, and then 3 years to invest your fund. Sometimes you can go through it a little faster, and if you don't find good deals, you just don't invest. You just wait. And if you're really being too picky, sometimes your LPs will say, "What are you doing? You mean to tell me there's no one to invest in?" And sometimes you have to broaden your thesis a little bit. It's like, I know I said I was going to only invest in these kinds of companies in this particular region, but now I got to make my region bigger because I'm not finding the companies. The other thing you do is you just, if you as an investor said, all right, I'm going to invest in 1864. I'm going to put $150,000 in. Great. I went $50,000 now. When I get low on my funds, I'm going to come back to ask you for the second 50, which is probably going to be at about 9-12 months after your first 50. And then 9-12 months after that, I'm going to ask for the final installment. So I'm not tying up your cash in my fund if it's not being invested. So this idea of having capital calls and tranching is another way to preserve your investors' capital so that you're not asking for it way before you need it for making your investment. So if things are going out a little slower, well, you just don't ask for it. Things are going out faster. If it's a really competitive market and you want to put money at play, well, then you're making those capital calls a little bit sooner than what we told you that we think is going to happen.
Thank you.
You're welcome.
Any more questions?
One more question.
But so quick question is VWAP the same as the weighted average that you were talking about earlier?
Is what?
VWAP, value weighted average, is that the same as weighted average?
Yeah, it's a different way of saying the same thing.
Okay. And then how much of the investors discount the company based on like the current market conditions?
So the discounts right now, they're still 20%. I've seen a few that are as high as 33%. I saw one a month ago of a company that was surprisingly mature for the 12% interest and the 33% discount that the founder was offering without even asking. It was clear that he wanted to get a deal done. And you don't know, when you see that as an investor, you think, either he just wants to raise the money now and not fuss around with it. I wonder if there's something else that I don't know about, that he's offering a price that's better than sort of normal for the market that we're in. So, most of the time you see an 20% discount, and 10, 12% interest is the kind of the sort of norm right now. So that's just what the market is at right now, and it changes. Next quarter could be different. It usually doesn't move that much. I mean, I've seen the interest rates on convertible notes move from 4 or 5% a year ago, and they're pretty much all 8, 10, 12% now. But interest rates are high, so not a surprise.
Question online. Tasha's asking, what are the angels' required ownership percentage?
It varies by angel. So we talked about it a minute ago. So some angels have a thesis that says they need to own 20%. It's a little high for angels. Funds usually will have a very specific thesis about a minimum amount of ownership. But if you're going to angel groups and individual people, that varies all over the map. They don't usually have a specific target.
Thank you. Anybody else?
No, I just had a
Not the
question
question.
about exiting. So, like exiting on the, like if your sales suck, right? And you know, your investor wanted out, or because the notes are convertible, maybe they have more power.
No.
Nope.
No. Unless they've written into the note that you have to pay them back, there's really no place for the investor to go. They can try to call the note, but if you don't have the money to pay them, then they would essentially be putting you into bankruptcy, which means they're getting no money, right? So the chances of that happening, it's not impossible, but it's pretty low. And since the convertible notes, unless you've got a really sharky investor, they're not asking for personal guarantees. You know, it's mostly based on what the company is doing. And if they're going to put you out of business, unless you've got something really valuable in your business that's not able to be turned into cash, like if you own some really interesting IP that they figure, all right, if I put the company into bankruptcy, I might be able to sell this IP on the courthouse steps for a lot of money and get some of my money back. That's a pretty brutal route. I mean, you would have to have burned a lot of bridges and underperformed for a long period of time. I think for most investors would take that route. It's possible, but it's unlikely.
And then going public, just kind of piggyback off of that to pay the investors back.
That is the dream for most founders, is to go to build a company big enough that you can IPO. It's a pretty tough road. Usually there's many rounds of investing before you get to the point where you can take a company public. I've been part of it 3 times. You don't get paid back. I mean, the investors generally will get their money back pretty quickly, but the founders and the insiders, I can tell you the first company I was with that went public, we went public in February of 2000, and the market collapsed in May of 2000. So our shares came out at $14 a share. In March and April, they were $56 a share. We thought we were all billionaires. When we could sell, then the market dropped in May of that year. By the time we could sell 6 months later in August, the shares were worth 65 cents. It took 7 years to dig out of that hole. And hardly anybody made money on that. It took a while. Most of the people made some of their money back. But even though I say, okay, it was an IPO, we were successful, it was like almost the worst possible time that you could go public when the bubble burst in 2000. So that was brutal, even though we did go public. And in most cases, you're not seeing many companies go public right now because the path is pretty hard in this market. And there's so much money in private equity that it's oftentimes easier to just get your company bought by a private equity group or by a bigger company because the money flows much more quickly. And I've even heard, some of the podcasters out there saying, well, going public now is just a pump and dump scheme, right? You're going to sell to a bunch of unsophisticated people in the stock market which is why you see a lot of these stocks pop and then go down, because the fundamentals behind the company weren't good, but the investors needed out, right? And it's a way that you can, as an investor, get some liquidity when the company goes public. I mean, that's a pretty radical view in terms of like having it be some sort of pump and dump scheme to go public. But you've got if you get to the position where you have options for exiting, it's a great position to be in. Do I put the company up for sale and look for some private equity or some larger company to buy me out, or do I actually have a chance to take the company public, and can I survive that journey? It's a huge win when you can do it, because that stock will continue to go up over time. Hopefully, if you're doing a good job, it goes up over time if you price your offering right.
Last question, I'll be done. The investors replacing the founder. I guess what's the thought process behind something like that?
Yeah, that's where having the board, understanding how what the board makeup is, because the board is who hires and fires the CEO, right? And if you as a founder have 2 of 5 positions on the board that you control, or 1 of 5, well, if you're failing, they're going to replace you. It's a really hard decision for a board to make. It's not something they take lightly. But it happens. It's not unusual. It's not common, but it's not unusual. There are not a lot of founders who are the right person or have the right skill set. The same skill set that it takes to go from 0 to 1 is a different skill set that it takes to go from 1 to 10. And a lot of times when the founder gets to a position where they're out of their depth, they were the right person to invent it. They were the right person to be the advocate and to proselytize their thing and get it to a point where it could be taken over by a professional manager. You know, it really depends on your board, your company, your skill sets. And, you know, there's a lot of founders who make that journey really well. And there's others that really struggle with it. That doesn't mean that you as a founder aren't going to get paid. I mean, you're still going to own, even if they fire you, you're going to still own whatever percentage of the company that you had. I was listening to a podcast this morning on the way here today about one of the founders of Etsy, who was fired by the board. And he admitted, it's like, he's a guy that's a creator. He was a builder. But once the company got big, the board just said, great job getting us here, guy, but you're not the person to take us to the next level. Now, he's done, he owned 3 or 4 or 5% of the company at the time he got fired. It's big. It's an $8 billion company. You do the math. That's a lot of money. Is he a little bitter because they didn't give him the chance? But, on reflection, it was like, yeah, probably wasn't the right person at that point to take it forward from there. So it really depends on, now you look at another founder, like the founder of Dropbox, Drew Houston, has made the entire journey from being a student at MIT when they started that company to this, I think it's 250 million, I think it's like $2.5 billion company. He's made the entire journey and done a really good job of it. It really depends. Now, for me, I've usually tapped out when the company got to be about 500-600 employees, and all the professional second guessers come in and start saying, why are you doing this and why are you doing that? It's like, you know what? Here's the keys. I'm going to take my stock. I'm going to go on to the next thing where my 0 to 1 talent is usable, right? When it gets to be a slog, I start to lose interest. Personally, I've learned that about me. But there are other people who's like, nope, this is my baby. I am not giving an inch. I am going to run this and grow it as big as I can. Again, we're all snowflakes. It's really down to a combination of our skill sets and our desires. All right. Well, that was about a half hour longer than I thought I was going to be. And it's now dark. I don't see any trick-or-treaters out here on 4th Street, but then go a couple blocks down to Fremont Street. We'll probably see.
Oh, wait, you have one question online. I'm so sorry. Shivam is asking, what kind of agreement do you make while receiving funds from your friends and family? Do you offer a flat equity on it?
If I was doing it, I would put my friends and family into a safer convertible note rather than selling them straight up equity, because when you do that, you're valuing your company. When you sell, you're going to be $5,000 for 5%. All right, you just valued your company at $100,000, and maybe that's fine, but I would rather put it into a convertible note or a safe where you're saying, I'll give you a valuation cap of $1 million or $2 million. But I'm going to take the 5,000, or just take it as a loan if they're willing to do that for you. That way you're not selling. That would be, frankly, from a founder's perspective, the best thing to do would be to take a loan, even if it was at a really aggressive interest rate, because you're not giving up interest, you're not giving up equity. But I would always prefer in those very early rounds to take it as a convertible note or a safe rather than straight equity.
That's it.
All right. Everybody have a happy Halloween, and thanks for coming out, to those of you who made it down here tonight, and thanks to everybody online. We will see you back here next week.